Asset inflation inequality is the direct result of how central banks have managed economic crises since 2008. The expansion of advanced economy central bank balance sheets from $5 trillion to $30 trillion between 2008 and 2023, according to BIS data, was meant to stabilize markets and stimulate growth. But the reality is that most of this liquidity flowed into financial markets, not into the broader economy. A large majority of QE funds entered asset markets, reinforcing the portfolio balance channel and lifting equities and real estate far more than wages or business investment. When central banks buy bonds and inject liquidity, financial institutions look for higher yields, driving up the prices of stocks, bonds, and real estate. Studies consistently show QE's impact on asset prices far outweighs its effect on GDP growth. Asset holders, already wealthier on average, benefit disproportionately from these price increases. The result is a widening gap between those who own assets and those who rely primarily on wages. Household net worth roughly doubled between 2008 and 2021, rising from about $50 trillion to $130 trillion, according to Federal Reserve data. Yet this growth was not shared equally. The Fed's survey of consumer finances shows a disproportionate share of asset price gains accrued to the wealthiest households. The top 10% hold the vast majority of equities, and a similar concentration exists in real estate and other appreciating assets. Meanwhile, median real wages rose only in the single digits over the same period. All of this activity pushed asset prices higher, while wage growth lagged behind. Home prices in major cities have soared, putting ownership out of reach for many. Investment firms now own large shares of residential housing, while first-time buyers struggle to compete. Stock market gains overwhelmingly benefit those who already have significant portfolios, reinforcing existing wealth gaps. Monetary policy, especially through QE, has become a structural driver of wealth concentration. Central banks acknowledge that their actions have distributional effects, but these effects are rarely emphasized in public statements. The policy framework rewards those who hold assets and leaves wage earners and savers with diminishing purchasing power. Understanding this dynamic is crucial for anyone trying to navigate the modern economy. Asset ownership is now a prerequisite for keeping pace with rising costs and maintaining wealth. This environment is not the result of random market forces, but of deliberate policy decisions that prioritize asset price stability and market confidence.